Welcome back, friends. In today's video, we will be talking about the form and contents of the profit and loss account, which means we'll be talking as to how a profit and loss account looks like. What are the various ingredients which go into making of a profit and loss account, right? So in order to understand the preparation of a profit and loss account, we need to understand that it comprises of two elements, which is income on one hand and the expense of the on the other. And as the matching concept says, both should be related to the same period. That's it. If you remember this thing, the preparation of profit and loss account would be very easy for us. All we need to know is we need to understand what are the elements of income, what are the elements of expense. We need to ensure that both of these income and expenses are related to the same period. Then what we'll do, we'll be matching this income with the expense for the same period in order to arrive at the profit or loss for a particular period, right? So what is a P&L account? It's a summary of all the accounts. How is it a summary? It means what we need to do is, this is a summarized format of revenue and expenses. Summarized format of revenue and expenses. Let's see how. It says it is done by summarizing all the individual accounts, accumulating. Say for example, if I say the sales for the month of April was 20,000, May was 40,000, June was 50,000. I would say sales for the period were 20 plus 40 plus 50. 1,10,000 would be the sale. What I am doing is I am summarizing the total of sales and writing it as a single head, sales for the period, which is 1,10,000. Similarly, the expenses, say for example rent paid in the month of April 10,000, May 10,000, June 10,000. I paid rent for all the from starting from April till March, it was 10,000 every month. So what I would do is at the end of the year, I would say rent expenses were 1,20,000, 10,000 into 12. Or say for example, if I paid salary 5,000 a month, I would say salary expenses for the period would be 60,000, which means I would be summarizing, I would be totaling all the individual accounts and then I will be showing it under the head expense or the revenue, right? We have seen this accounting equation which says asset is equals to liabilities plus capital. Now we need to extend this accounting equation which says you have some revenue. To this we need to make two adjustments. One is with reference to the expense and the other one is with reference to the dividend. What is expense? Expense is the amount which you incur in order to realize or earn the revenue. Dividend is the portion of the profit which is distributed to the owners. Distribution of profit. So the difference between these two is called as your retained earnings, right? The revenue minus your expenses and dividend or drawings. If it's an individual, what he would do is he would take out some amount out of his capital for the purpose of his regular or day-to-day expenses, which is called as drawings. So what we do, out of revenue, if I deduct these two things, expenses and the dividends or drawings, then I would say it is the retained earnings. In other words, I can say retained earnings is the portion of profit which remains undistributed. What is profit? The difference between revenue and expense is your profit. If the whole amount is distributed, the profit becomes, retained earning becomes zero. If nothing is distributed, the total amount goes to the retained earnings, which means retained earnings is the amount of profit which is retained back, which is not distributed. Let us try understanding this by way of an illustration. Say for example, during the accounting period, Ramsons buy 12 units of inventory for 1200. He buys another 10 units on credit for 1000. He buys another 10 for 1000. Now the accrual concept says whether you buy it for cash or if it is on credit, your total purchase would be for 22 units or 2200 rupees. Clear? Then it says out of this 15 units of inventory were sold during the period on credit for 2250. This is the purchase. You have sold 15 for 2250. 5 units were sold again for 750. 5 sold for 750, which means total units sold are 20 for an amount of 3000 rupees. Right? We need to understand that out of 22 units which have been purchased, you have sold 20 units, which means you have a balance of 2 units. And if I take out the cost of those 2 units, it comes to 200 rupees. How did I calculate that? You have purchased this 12 units for 1200 rupees, which means the cost of per unit is 100. Here again you purchase this 10 units for 1000 rupees. Again the cost is 100 per unit. So if 2 units are unsold for you, which means the cost of these 2 units, which is 200 rupees, remains unsold as closing stock for you. Right? Now let's see how to calculate the profitability from these transactions. So this is the horizontal the vertical format of P&L account, wherein we have seen the revenue for the period, which is 15 units and 5 units sold. Let me change this color. Yeah. 15 units sold on credit, 5 units sold on cash, which means 20 units have been sold. The amount for that is 2250 and 7750, which means 3000 is the total revenue for the period. Of this is the cost of goods sold, assuming that there is no other cost except the purchase price. So we have sold 20 units, right? So the 20 units at a cost of 100 rupees, which means 2000 is the cost of goods sold, which means my profit for this period is 3000 minus 1000. This would be my profit for the period. This is the way how I present in the vertical format. Looking at the horizontal format, what we do is we need to write the expenses on one hand and revenue on the other. What I have done, my sale for the period, if I look at the sale for the period, this was 3000. Let me write it here, 3000 rupees. And out of this, my cost of goods sold was 2000. So what I saved was 1000 rupees, or my profit is 1000. So if you look at the profit under both the sides, both the methods, profit would be the same. Only the way of presentation keeps on changing. Like we have seen in case of balance sheet, there was one horizontal format of balance sheet and the other one was vertical format of balance sheet. All the items would be the same, only the way of presentation changes. Right? So the profit under both the methods would be same for you. Now we need to consider the future possible expenses also. How do you do that? We have seen in our earlier class that whatever future expenses are needs to be provided for. Now the question arises, how do we provide for an expense which is going to happen in future? We need to make appropriate estimate for that. Right? We need to make an estimate to that extent. Sometimes the costs are incurred directly in relation to the revenue of a given accounting period in the subsequent period. The revenue is for this period, but the expenses may come to us in the coming time or in the subsequent period. So the amount of such expense, since it is related to future, we need to estimate them relating to an accounting period in order to make a reasonably accurate measurement. We have seen the matching concept, which says if the expense is related to a particular period, we need to match it with the revenue of the same period. So if we find that there is some expense which related to this period but it may come to us in future, we need to make a reasonable estimation to such amount and we need to account for that also. Say for example, provision for bonus. What is this? We declare bonus which is to be paid in the suppose next financial year. What we do is, this bonus is for the work done in the current year, but this would be paid in the next year. What we have to do, we need to make a provision for that. We would say, okay, this amount of expense towards bonus would be recorded as an expense in this very year. The name of that would be provision for bonus. If it is actually paid, it would be bonus expense. If it is not paid, if it is payable, we would say it is provision for bonus. Similarly, you have an expense called as bad debt expense. Now, what is this bad debt expense? This arises out of credit sale. If you do not sell everything on cash, which means something, some item of that is sold on a credit basis. Credit basis means you are going to receive that money in future. So, your credit sale is converted into receivables to be received in future. Out of that, if something is unpaid, it would be called as bad receivable, or in accounting terms we say it as bad debt. So we need to write that bad debt off as an expense for this particular period, expense for the period when the sale has happened. This loss would be happening in future, but when we estimate that this is amount is, suppose if someone is declared insolvent and if you come to know about that, what we do, we charge that as an expense under the head bad debts in the very the same accounting area, same accounting period. Let us talk about an illustration. Say for example, if a business is started in the name of Roshni Traders with the owner's equity of 25,000. The business makes 4 credit sales of 2,400 each, which means the sale is 10,000 rupees. And the cost of sales is 5,000. All the expenses incurred to generate this revenue is 5,000. So I would say simply my profit is to the extent of 50,000. And at the end of year, my capital would go up from 25,000 to 30,000. Simple. Let's see. Suppose if it says that one of the credit sales becomes doubtful, which means 2,500 out of this 10,000 becomes doubtful, then my profit of 5,000 gets reduced to 2,500 because I won't be receiving this 5,000. Clear? Going by the same logic, let's see how the accounts look like. Here, if I prepare the P&L account, on one hand I write the income, on the other I write the expenses. So I would say income generated during this year was 10,000 rupees. For this, my cost which have been incurred to generate this revenue was 5,000 and profit was 5,000, right? We haven't considered the bad debt here. Now let's see. The income statement or the balance sheet says my accounts receivable are 10,000, other assets are 20,000, total assets are 30,000. Similarly, my retained earnings means the profit which is not distributed, which is 10,000 as of now. And then equities would be to the tune of 20,000. Right? So I would say here, the both side of the balance sheet matches 30,000 each. Clear? If I account for the bad debts, then see what happens. My revenue is same. My cost of goods sold is same, but there is one expense in the name of bad debt expense, which means my profit which was supposed to be 5,000 has gone down to 2,500 here, right? So the profit goes down by the amount of bad debts. Bad debts means the amount which won't be receivable by me anymore. Similarly, if I look at the balance sheet, it would say my receivables were 10,000. See, earlier also my receivables were 10,000, but in this I would say estimated collection loss in form of bad debts would be 2,500, which means my actual receivables are 7,500 only. And the other assets were of 20,000, it remains unchanged. So what happens is my other equities would be 25,000 instead of 30,000 here. Right? So what I have done is my equity which was supposed to be 27,500 has gone down to by 2,500 because of the bad debts. which means the estimated collection loss of bad debts has gone down, it has reduced in my profitability, or my bottom line or my total profit for the period has reduced by 2500 due to the balance sheet. Now let us see how a balance sheet typically looks like. We'll be using the same illustration to explain all the terms in our future classes. So let us see how a income statement or profit and loss account looks like. On one side you have, on the debit side, we'll see what debit is, what credit is. Just remember that on the debit side you write all the expenses. On the right side you write all the incomes, which is called as the credit in the accounting language. So income means whatever sales are there or other income is there, this is your total income. Out of this total income, what you do is you deduct your expenses. 260 minus 130 gives you 130, which is called as your gross profit. Then this completes the first stage, which is called as your trading account. Then you have the profit and loss account, which starts with this balance, which is the gross profit. Out of this gross profit, what you do is you deduct the different types of expenses. Sorry, these three. And the schedule number gives you the details of all this. We'll look into this while in our future classes. What schedule are, what are the things which go into the schedule, right? Then what we do is after this gross profit, if we deduct all these expenses, what we are left with is the operating profit. And out of the operating profit, we deduct the interest paid. This gives you the profit before taxes. Out of the this profit, if I deduct the taxes, then what is left is the profit after tax. Right? What I have done, out of the income, which is 260, I deducted the expense, which are 130. What is remaining is 130. Clear? From this 130, what I did is I deducted these expenses, 49 plus 11, 60 plus 28, 88. So what remains is 42, which is called as the operating profit. Or this is also called as the profit before interest and taxes, PBIT, profit before interest and taxes. From this, if I deduct the interest out of 42, if I deduct 12, what remains is profit before tax, which is 30. Out of this 30, when I deduct 12, what my profit after tax is? Profit after tax is 18. This is the way how I present the profit and loss account, right? The same format, if I change that into vertical format, what happens is on the top I record all revenues. Sales, other income, my total revenue 260. Out of this, if I deduct my cost of goods sold 130, my gross profit is 130. Out of this, if I deduct my operating expenses, what remains is my operating profit. Out of this operating profit, if I deduct this, it becomes my profit before tax. Here I said this is the profit before interest and taxation. Of this, if I deduct this interest, what remains is EBT, profit before tax, earnings before tax. If I deduct the tax also here, what remains is profit after tax, which is 18. So the amount would be same under both the cases, only the way of presentation would change. In the earlier format, we have seen two sides. Here you write the expense, here you write the income. What you have done is, the only change is, here you have written the income and all the other items here are related to the expense, or the way how this profit has been used, right? So let us summarize as to what we have done in our class today. We have talked about the profit and loss account, which is nothing but the summary of the revenue and expenses. We can prepare this in the horizontal format or the vertical format. Then we have seen an illustration wherein both the horizontal and vertical format of income statement or P&L account was discussed. Then we talked about the bad debts and the manner how it is recorded. All you need to know is bad debts would reduce your profit or your equity or your retained earnings. Then we have seen how the profit and loss account looks like. We have taken an example, and I said that we will be using this example only throughout our contents classes, right? What are the contents which go into the P&L account or the income statement? In the next class, we'll be talking about the components which go into the P&L account. We'll be talking as to what sales are, what sales return is, what cash is, what cash discount is, what trade discount is. We'll see what other incomes are. We'll see what a cost of goods sold is, how to calculate the cost of goods sold. Then we'll also see what a gross profit is, or how do the companies calculate the gross profit. Clear? So thank you so much. Thank you and bye.